Negotiations between US and Canadian trade representatives broke down late Friday night. As a result, the rarely used Section 338 tariffs, which place 50% levies on select Canadian exports to the US, have now gone into effect. This will hit around 5% of Canadian exports to the US, with affected sectors including electronics, wood products, machinery, furniture, among others. In response, Prime Minister Carney has announced that Canada will retaliate with new dollar-for-dollar tariffs on select American goods that are expected to go into effect on September 8th. This is important given how large the trade relationship between the two nations is. For instance, total trade between the US and Canada has grown from $454 Canadian billion in 1997 to $1 trillion in 2025. The direct economic hit from these tariffs is manageable because the affected exports are relatively small. However, the bigger risk is that the tariffs signal a fundamental deterioration in the Canada-U.S. trading relationship. First, the Section 338 tariffs provide no exemptions for goods that qualify under CUSMA. That is critical given that over 90% of Canadian exports to the U.S. had still accessed the American market duty-free since Liberation Day in 2025 due to CUSMA protection. However, it now appears that the U.S. is more willing to circumvent CUSMA than previously assumed. Second, under 338, the maximum tariff rate that can be applied is 50%. The key risk is escalation. U.S. retaliation to Canada's planned dollar-for-dollar tariffs could broaden the scope of affected exports, while labor-intensive industries may face second-round effects through weaker business confidence, investment, and employment. In fact, U.S. President Trump has announced that 50% tariffs will apply to Canadian autos, auto parts, and steel on January 1st. For now, markets remain focused on whether negotiations resume in the coming months. Our base case is limited further escalation from here, but a broader trade conflict could push USD CAD above 140 and lead markets to price out projected Bank of Canada rate hikes in 2026 and 2027, and prompt additional fiscal support for both federal and provincial governments. Thank you for joining us this week, and we'll see you next week.